Hello, welcome to Cryptonomy. So, I am Mo, and in this channel, we're going to talk about Bitcoin, crypto, and how economic factors affect the cryptoverse in general. So, I've been an investor since 2019. Um, Actually, the first time I invested in ADA, everything went down. I managed to get the peak, but I haven't sold till recently. Yeah, so we revisited the highs and not the highs, but somewhere in the mid. I sold some ADA because I really don't see any future in ADA and bought Bitcoin instead. Recently my portfolio has been Bitcoin heavy, and this is because actually interest rates were pretty high. The thing people don't understand about interest rate is that when interest rates are high, you should really diverge from risk assets into like more safer assets like Bitcoin. I, to be honest, acted late despite me knowing this, and I've made some profits in the altcoin market, but then gave most of it away because I was too scared to press the button and be like, okay, semi-risk asset, let's jump to Bitcoin. So in this channel, what we're gonna do is we're gonna understand how economic factors affect crypto and how to make better financial decisions. So just a little bit about me. I graduated in computer science. I'm a data scientist, so always my approach is data centered and around analysis from previous times, and I take into account what other YouTubers and investors say, and then I do my own analysis, which you should as well, to make the informed decisions I am making to make sure my assets and my hard-earned money safe in the cryptoverse. Um, my favorite investor is Ed Seykota. My favorite investing book is Reminiscence of a Stock Operator, and I've read around like 20 investing books. My favorite Bitcoin general book is The Bitcoin Standard, and that's just a little bit about me. So here we're gonna start talking about why I think Bitcoin will probably revisit its all-time highs and break them in quarter four. And the reasoning is pretty simple. There are risks, but this video will be focused on the bull case. The bear case is gonna come next time. But I'm just gonna show you why actually we might break all-time highs. And as we speak, Bitcoin is revisiting. Well, it broke out, and then we're revisiting the lows again. That's fine. That's probably due to a lot of leverage, as you can see. I mean, we're just getting those guys wiped out. That's pretty normal. I'm also a little bit sick, but that's gonna be okay. Look, so right here there's a lot of leverage. So much more than up there. And those guys are just gonna put us back down. I mean, BlackRock is happy to see this, alright? And Binance, OKX, whatever, market makers, they just want to take their money, okay? So, stupid. I mean, if you're a trader, you should know how much leverage is being there, and prices tend to usually move down to leverage or up if leverage is up. Now everybody's hyped, get them, and then we continue up. And why would BlackRock and other investment banking firms, blah blah blah, fund managers, want to get a lower prices? I mean, they spend a little bit of money, get the leverage out, help them get the price lower, and then they can get Bitcoin for a little bit cheaper. So don't panic. What you should do is make your analysis, understand the market, understand when it is actually risky to be involved in the market. For example, in my own case, if we break here, I'll start again be worried. If we make another lower high, and maximum I think we would see another lower low to 47,000 or something like that. But that's like a 30-40% chance. 70% chance I think we're going up. And let's talk a little bit about that. Alright? So first, what do you do if you're new to the cryptoverse, or even if you're an old investor? You understand you need a center point, right? So what's the center point we can work with? I think that would be nice to have the Bitcoin halving, even though some people are saying, oh, the 4-year cycle is like not working anymore, blah blah blah. Well, of course it's not working anymore because you have big dogs coming to the market now, which is like BlackRock. This a new variable that will shift the cycle in a way. And this cycle is not because of nothing. It's actually a cycle because of, it's not because Bitcoin has a 4-year cycle. It's a 4-year cycle because there are other economic conditions that drive the cycle. All right, and maybe your homework would be to dig onto what are those economic conditions, what are those variables that affect the cycle. We will dive deep into that, and we're gonna dissect the 4-year cycle into its economic factors and other factors that influence it. So when a new factor get introduced to the equation, you'll be like, okay, maybe this is happening because of that. So, of course, we've never reached our all-time high, but as we're gonna calculate, all right, look here, from the halving, 7 month out, you would get revisiting of a all-time high. You see here? Right there. Okay? And once that loads, if you go here again, then you'd also see all-time high, bada boom, 7 months later, you'd revisit the all-time high. Okay? But here, we've revisited the all-time highs much earlier, even before the halving. I'm talking 7 months after the halving. Why that? Because you got a new factor into the cycle. You got BlackRock, ETFs, more money coming in. So I would not imagine that. I would imagine that Bitcoin goes even higher than we expected before, which is before the ETF's approval. I would assume Bitcoin goes to 100, 150,000, but after, and that's because of the returns get less as the asset matures. And anyway, now we got it so much earlier. But if we are to measure 7 months out, which is if you take the average, right, 210 and 220, you would say 215. Here we just got 14, whatever. November 19, we should be at the all-time high. So we're early. I mean, if you invested here, which I did, then you would understand that we got more profits early. That's fine, right? And usually the correction here, as you can see, the all-time high correction doesn't last long, usually, right? It's not so, here we did touch it, but we came down. It just didn't last as long as that. I mean, we can measure that here, and we can see. Let's delete those. Oh, nice. That and that. If we measure from here, or let's measure it from here, that took around, to break the all-time highs again, 100 days, around 3 months, 4 months. If you measure it from here, it took almost nothing, right? Like 46 days, give or take. Right now, we've touched the highs here, but we haven't even broken out, and it's already 177 days. And if we break out, maybe like at the time we're supposed to be at all-time highs, which I don't think so. I think it's gonna be earlier, and I'm gonna say why soon. It will be 256 days. That's like around 100 days more than usual. Look, let's dissect. Given that this jump, BlackRock, whatever ETF is not there, let's dissect what happens after the halving to try and understand what is happening, right? So we usually get a post-halving correction right here, as you can see. That's in the 2019-2020 cycle. You get a post-halving correction, and then you get a post-halving pump, right? Same here, post-halving correction, and then you get like a post-halving pump kind of thing right here. See, 21 and 54 days respectively. And if you go here, it's around 14 and 17 days respectively, right? So I took the average, and the average is 17.5. We got it in around 10 right here. If we say this is the point, right? And what came after it, right? We get a post-halving dump first, and then a pump after 26 days. Usually average is 35 days. Right here. See, that's the halving dump, pump, and that's the dump. After that, You can dissect it any way you like. We can say that this is a consolidation. And one thing I forgot to mention is we usually form a wedge in form of a triangle. Here we broke it, but nevertheless we do form a wedge usually. We were respecting that. But here I remember something like the Israel and Palestine war happened. That's what, see, other economic factors can influence the cycle. That's what broke down the wedge here. Here was the SAM rule trigger, right? That's where we broke the wedge again. But we usually get a triangle wedge type of thing, right? Here, triangle wedge, and what we're looking for is this triangle breakout. This is what I want. I want this to break out. I want to know when and if it happens, right? So here again, kind of wedge thing. Yes, we can sweep the high, sweep the low sometime, but nevertheless we do form some form of triangle. And once we break out, that's why this breakout is so important, because once we break out 2017 here, 2016, 17, bam, right here, once we break out, retest, bam, right? So this is what we want. We want this little beautiful breakout to happen there. What can we do? Well, one approach would be to take the average again, right? I mean, it's not an exact number, but come on, you're never gonna get any exact numbers. You're gonna get probabilistic approaches and something near, give or take some standard deviation, minus 10 days plus 10 days. That's investing, all right? So here I'm talking about investing in 1 to 2 years. I'm not trading this. I would trade for fun, but I'm investing. And if you're an investor, you came to the right place. So let's see here. You break out 77 days after the halving. All right, 77 days right here. Breakout, retest, jump, bam. Here, you break out from this wedge, and any way you draw it, you can draw it, doesn't matter. 112 days. So, if we take a little beautiful average, alright, I'll explain what is that soon, just let's bring it down carefully. 95 days. That's the average. Well, the average is gone already. You see? We got the SAM rule trigger, bam. Maybe in another universe where the SAM rule did not trigger, maybe we would have broke out here on the average. Who knows? We were set for a very powerful move right there. It was a nicely powerful move. Some people suspected anything about the employment rates there, the numbers, and they probably did the calculation and they were like, oh, maybe that thing would trigger at like 3.1%, I remember, or something. And maybe that's why some of the whales didn't buy, and that's why the price started to fall down. Who knows? But anyways, it's for guidance. But let's say, give or take, right? And another way, we said there are two ways we can probably determine the breakout. We can take the halving, or we can take the time of the year, right? Because why does crypto usually do good at that time of the year, at that election year exactly, is because of economic factors, right? What happened in end of 2016, end of 2020 here, and 2024 is an election year, right? So the time of the year does matter. So here you broke out in July, end of July actually, we can say August of 2020, right? Here we broke out end of October, so we'd say November of 2016. So if you take August here, right here, August to November, just like give it a little bit extra, right? Give it a little bit extra because that's the all-time high right here. Maybe this would be a psychological factor. Be like, yeah, we need to be 7 months after the halving to really break out from our all-time high, right? Because that's the time we historically revisited. Okay. So, give or take. That would be the area I wouldn't be worried about if we still play around in this range. Because historically, we haven't broken out from this wedge, which was below the all-time highs, by the way. anytime in here. Alright, we should break out sometime in here. If we don't, I'll start considering to lower my risk in the cryptoverse and cut my investments. But for now, as long as the price is just hovering in this range between 53 is too low to be honest, but 53 to 72, 73, then that's fine. Right? Let's extend the wedge to know that's exactly when we're gonna wait. Alright, so after you break out from the wedge, we usually don't even start to have an exponential run yet. We get a post breakout dump and then a post breakout pump, and then we get the exponential. We get other stuff, but that's for another video. Alright, so here we break out. If you focus right here, we broke out, we dumped, right? We broke out and then we dumped or retested right away, and then we pumped, and there's like dumps and pumps on the way. Exponential, I'll consider it from here. So that happened 118 days and 130 days respectively, right? Dump, pump, 113, 150 respectively. Here's the dump, the retest. Here's the pump, which where around the exponential run comes. Take the average again, and don't worry, we already passed those averages. 134 days, or almost did. Post breakout dump, and then post breakout pump. 140 days if you take the averages. Again, we didn't break out, but those are to be expected after we break out. Once we break out, we start. Maybe you could trade the dump and pump. Those would be some nice trades that worked previously. I would expect them to work again, but again, I don't usually trade them. I'll get into that later, but right here we're just investing. Then you would finally get the exponential returns, right? If you study the previous two cycles, you get 161 days for the 2020 cycle, and then 165 days for the exponential. I'm taking the exponential to be here, right there, for the 2017 cycle. Average it out again, you get 163, hopefully. Alright, that's an average, give or take 20-40 days, but I'll start looking into that after we actually break out. But we do know that a breakout is coming historically. So that's one reason I believe that we are following the cycle normally, except that we broke out the wedge and we're actually consolidating for much longer than we needed. For example, here you did consolidate for like 152 days. Here we consolidated for around, I would say consolidation started here to here, 122 days. Here we're consolidating for a longer time, 174 days, right? Already 20 days longer than the most consolidation, but you also need to think about it. Here we're getting we got a mix of things together, mix of variables, alright? Because the ETF made us pump so hard that we got the halving, the all-time high lag here, right? We get the all-time high lag, got the pre-halving lag, post-halving lag, consolidation periods. You jumble those together. Here you got minor capitulation, right? When miners start lose money after the halving and they have to sell. You got governments like Germany and America and Silk Road and Mt. Gox all selling their bitcoins. You've got many factors that made the consolidation period longer. You've got some war risk, right? Everybody was scared of World War III. Now we're getting some virus risks. It's a lot of things playing together at the same time, and because we just sped up in time a little bit, you get the two lags, the all-time high lag and the post-halving lag jumbled together with all their crises into one beautiful piece of 7 months of consolidation. This is why we're taking longer than we should. But look ahead, we got the election year coming up soon, interest rate drop. By the way, usually when interest rate drop, it's not a good sign for risk asset, because when the interest rate come, it's usually because the Fed broke something in the economy. And when they break something in the economy, you get sad markets, right? You do get sad markets. For example, here this is for another video, but where I'm gonna bring some data pieces about that. I was having load recession analysis. Okay, look. This for another video, but when you get interest rate to drop, except this period, this is why I'm having some hopes. But you go look at the mortgage collapse, right? Supreme mortgage collapse. Interest rate dropped, and the S&P dropped as well. .com interest rate dropped, and the market dropped. Here you dropped minor, but we still rallied, right? Here we dropped a little bit and still rallied. And the oil shock, which by the way, the Japan Nikkei fell hard Black Monday, that happened to us recently. The Japan scare, that happened there as well, before, in 1987. Dropped interest rate, dropped markets. Dropped interest rate, dropped markets. So, but recently the Fed started to focus more on soft landings. That's why here we dropped, and if COVID didn't come, we'd get a soft landing and markets will still rally. But historically that hasn't been the case, at least for those two instances as far as I know. I analyzed everything, and by the way, SAM rule, here's the SAM rule, that's the SAM rule, here's the inverted yield curve. We're gonna look into that later for the bear case video. For now, let's stay in the bull case, right? What I'm gonna do is I'm gonna delete some of that. I'm gonna explain to you a little bit about what is that, but basically this is a Fibonacci tool, right? You just take a fib channel, you take the lows here, you pull up the highs, and it's since the start of this consolidation I've been using it, and you can see the respect of these levels is just crucial. I mean, like, it's crazy how much we're respecting those levels. Right now we're coming down. I would just imagine we touch up, and if we fall down, this one will start take down risk. But if we continue up from here, I'm happy. But if we break down from here, I'm gonna be sad. I'm gonna be starting to think to maybe exit the crypto market for a while, at least a portion of it, like 20%, 30%, till I start thinking things are getting better, because this history doesn't show that we should follow this. Like, this shouldn't really happen so much. I like to invest based on facts, not on hope. And if we just break down from there, then we're just being hopeful, right? Unless you have other things to prove your theory. Anyway, notice that. I mean, if you go to Benjamin Cowan, he probably outlined that a lot as well, but the signs are visible. You're seeing a trend of lower lows and lower highs. Wait, lower lows and lower highs, sorry. As you can see, here we're making some lower highs, and we're getting followed by lower lows. Just as simple as that, right? You cannot deny that. And Let's pull the US interest rate, right? It's important to look at the new US interest rate. It's important for risk assets like crypto. And one situation that had similar interest rate situation was 2019. That's probably one of the only ones in the crypto history that we can actually look at. So that's the only one we can study for reliable measures and reliable facts to help steer our decision making, right? This period and this period, right? We are promised to get interest rate cuts where September 18, give or take. September 18. Just draw a line for now. Here. Change that to blue. Change that to orange. We should get interest rate cuts around September 18. Okay. Where did we get the interest rate cuts? Back in 2019. That's why I would also not follow this 100%, because yes, in 2019, as you can see, we did get lower lows. Well, that's lower highs. Lower highs. And just delete this. This was COVID-19, right? This is the interest rate. I would at least assume that is the interest rate effect on Bitcoin price. And lower lows. Right? But that happened after the first rate cut, which we don't know where it happened, right? I think it's around here. Started just before the first rate cut. It was 25 basis point, right? We were at 3, then 2.5, 2.25, right? That happened right here. Yep, in the July meeting, actually, that's true. That's when we got this trend. But we also know that markets are forward looking, right? So, markets are forward looking. Smart investors would actually have determined that rate cuts would come soon, and they would have already made the trend play out sooner than it actually did, right? Here we got this trend right after or just before rate cuts. Here we got it, I mean, like long time ago. I would not doubt. It's possible. That's one of the things that's scaring me. When interest rate cut comes, we usually trend down because everybody's fearful of a potential recession or economies going down or something. But we've got some data to counter this view on the market, right? But for now, it is still a risk. Well, anyway, since we determined that this looks like 2019, give or take, maybe it happened before or after, it doesn't matter, okay? Let's say that it happened. If you simply capture this trend right here. And let's capture the fun part too, alright? So you can have a little bit of dream about your bags getting pumped to the moon. You can go. And if we scale it, alright, so see how that looks. How does that look? Give or take, alright? We should range around this. Not in, okay, history does not repeat, but history rhymes. You always need to remember that. History does not repeat, but history rhymes. We're looking for some rhymes, alright? The price doesn't need to sing along, It just needs to hum along, alright? That's what you need to understand as well. Is there some humming going over here? Are we rhyming? I would bet you that it is. Right there. I mean, I did this countless times, but we just need to make it fit, right? In some form or another. And I've captured this piece of data. I would say that we need to play along the 2019 COVID crash, right? We got a COVID shock. Right now, here we got the Samuel shock, alright? It's a shock. It's a different form of shock, but it's still a shock, correct? And what do you see? I mean, I got this right here, alright, right here. I was tracking it from here, alright. I got this. I was like, oh, that looks like 2019, and I put it on, and I was able to determine right before the storm. I wish I was streaming back then, but I would have told you the pump is coming soon, and I adjust this accordingly, right? Every time we get new pieces of data, I either pull it down a little bit or pull it up and move it just a little bit to make it fit. But you do get the rhyme. Maybe if we do that, right? See? You would also understand that we did get a pump and a dump, right? Here we're just getting the dump. There wasn't the pump, sadly. But also here we got like the pump and then a dump, right? And then we just played along until we just pumped right there. And if you also notice, you see this very pain in the ass line that we just cannot break. Just try retest, fake it, retest, try, go, and we reject. What's happening here? We are struggling through it, and then we finally break it. We finally break it here. That's what this tells us, right? If we take the 2019 point of view on the COVID crash, we just need to rhyme with it. We need to sing along with it. And we would understand that, okay, this is something to look at, like, is following it. We wouldn't reject the hypothesis, still we get something to reject it, right? And what would reject that beautiful hypothesis? I'll tell you what would reject it. Something like that. Boom, boom. Not that one. You go away. A path. If we get something like this, and then bam, and then bam, that's hypothesis rejected. Alright, bye bye. Throw it in the trash. We don't need it. Correct? What would give us even more pieces of evidence that we're following it, right? That would be that. Tick. Even if we went down a little bit, it's okay. We're following it. Boom. Something along the lines. It doesn't matter what it does. Just don't deviate too much, around the structure that we were laying out here. And why is this also important? Alright, remember, when did we say that we should break out? October, November, right? November. That's from the first analysis, right? August, November, blah blah blah. We should end of October, start of November. This hypothesis suggests we should break out on that line that is around 72,685. Doesn't matter what's the number, okay? Here, 72,000 blah 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 655 instead of 85. Right there. November 1st. November goddamn 1st. I mean, come on. That should say something. If you get two different complete point of views, alright, before we were analyzing the Bitcoin halving, and what happens after, blah blah blah, what happens around the all-time highs revisit, the consolidation that goes on around there. So excuse me. And here we're taking into account the 2019, the interest rate cuts, da di da di da. We took a different pattern, we aligned it together, the math adds up. We're getting high resistant on that significant tangent. We're breaking out from it. We're retesting it, and then we're breaking out of that important 72,000 Bitcoin level at November. I'm not saying it could happen. I'm saying it's a possibility. We should keep our options open, and that's the bull case video. All right. So that's that. And what's beautiful as well, that it, even if you take that, okay, what's that line? All right, let's cover the. Look at that important line. All right, that's the bull market 2019 line. Right, we're reminiscing around it. Here you get the 2024 bull, 2023 x 2024 bull line. And we get something similar, alright? We're reminiscing around it. That's why I like this comparison. It just respects the tangents, the important tangents by the least, and also not the important ones too. I have another chart with a lot of lines and respects all of them. I just don't want to overwhelm you with it. I don't want to explain every single line there. So I made this simpler chart for you. And we get the 18th September rate cut. I would imagine a dump there on the news, dump the news, like always. But here we're getting something contradicting that pump, the rate cut. I don't know. That needs more analysis, but that one I don't know about. Again, if you take the same 2019 da snippet of bars, it shows you the respect between the important, what was that, the 200 EMA, 200 day SMA that everybody's been following, and the bull market support band. You just get a retest here. That's what this one says. It's not following it along. We need to see a little bit of more bars, daily bars, to understand, is it following it or is it breaking it. But on this account, we should be retesting, not projecting from the bull market support band. Excuse me. Alright, that's the wedge again. Look at that beautiful wedge. We're ding, boom. Should break out around November again. And that's maybe the wedge I drew there was not the most accurate. Right, maybe that's the correct wedge. Maybe we fell below it for a little bit. I'll just ignore all those lines. We will probably talk about that later. Again, the correction right now is too much leverage, too close to the price, everybody getting hyped up. And again, another bull case for why we should go up. The market cycle RY from the bottom, right? So if you go into the cryptoverse, RY after cycle bottom, I don't look at this one. This one just deviates too much. It's too early. We're reminiscing, and we're just above where we should be from the cycle bottom, right? We're on the track. We're on track. At the start, we were, very similar to cycle 3. Then we exceeded every cycle. Then we're just, we get, if you notice something, right? You get contraction, all the lines close together, and then expansion. The lines deviate. Contraction, they finally come together. Expansion, they deviate. Contraction and expansion. Now I hope the expansion of the market cycle 5 is not down. I hope it's up. We don't know, but it's gonna be very different in the expansion phase from cycle 4 and cycle 3. That's surely. Alright? Maybe in the middle, maybe above, maybe below. I would imagine it should be around cycle 4, right? Because ETFs, but diminishing returns equals maybe cycle 4 to different degrees. I hope it's cycle 3 though. That would be one hell of a ride. Okay, if you take the year-to-date RY, again here, year-to-date RY, you would see. Alright, let me just make it more simpler for you first. Take the averages out. You would see the 2024 in an inverse relationship of the 2020, right? Those are the halving years, 2024, 2020, 2016. Some people compare as well this year to 2017 and 2019. And I'm going to show you why they don't align. Alright, I understand. Interest rate cut, 2019, blah, blah, blah. But we're going to see why it doesn't really follow it year to date. Okay, so it looks like a halving year. It's a normal halving year. Just deviates sometimes, but we're right on track. We're right where it should be, right between the two lines. It doesn't matter. So 2020, we were inversely correlated, and then we contracted together, right? And then again, inversely correlated, right? Here, 2024 went up, 2020 went down. Here they came back together, right? See? This one slowly coming down, this one slowly going up. Correct? That's the 2019 crash, by the way, right? 2020 COVID crash. Yep. Then here we go down, we go up. But we're getting close to each other, right? Here, okay, you sometimes deviate. You don't have to be inversely correlated all the time. At some time, they're gonna deviate from this correlation when they see fit. I don't know what that means. When the variables change. Here you're getting 2020 going up, 2024 going down. And then we're starting to catch up again. I would imagine they start to be positively correlated with each other soon, if we were to go up, unless we go down. Because they're inversely correlated so far. Can you not see it? Up, down, right? 2020 up, 2024 down. Here, 2024 up, 2020 down, up, down, stop correlation, up, down, or like down, up, stop correlation, up, down. You see? But I would imagine we start. It's an election year. Liquidity cycle is increasing. The M2 money supply is increasing. The USDT, USDC, the tokens, the US dollar crypto tokens supply is actually going up, which correlates with markets going up usually. And straight cut soon. You'll see in another video why sometimes that may not be good, but in the long term that's a good thing for risk assets. So short term, usually not good, usually, stress on usually, but long term, always good thing. RY after having, oh wait, let's take 20 first. Alright, let's take the averages. If you average 2016, 2024, yeah, we deviated, but we're right back where we should be, right? So there's nothing to worry about. Here, I don't usually take 2012 because 2012 was like crazy. It's just, we just reminisced together for a little bit, but otherwise we were just far off in every way. So I wouldn't really take 2016, 2012 into the average, but here it is, okay? So 2019, yeah, the year of interest rate cuts, but does it even look close to being similar? Just no, we're just not really. I mean, yes, you get the lower highs and lower lows, but other than that, we're ROI in terms of that, we're just not there. Maybe the bottom, the shape a little bit, but we're just not there. 2017, also not there. We should have been way up by now. Excuse me. 2017, 2019, I doubt it. It's a halving year. It's an election year. That's what I see. They since halving. I mean, we're underperforming other years, but other than that, if you, from our other analysis, exponential should be alright. So here it's 160 days after halving. Here we are at 129. That's a month from here. That'll put us in, right now it's August, say September, October, which is close to November. So that would align us together. Usually August and September are a bad month for crypto, especially for halving years. No, sorry, in general, but for halving years it's usually okay. Here, 2020, you got one of them is red. Usually one of them is red in the halving years. Look, 2020, one red from August on, right? 2016, one red from August on. But if you take 2019, it's not looking good. It's one green, right? That's why I don't like to compare it to 2019 as well. The chart just, unless, other than the interest rate, the chart looks a little bit similar. But we got that come down in the, when interest rate were not just first cutting, but way before. I think we've already had that come down. We might not go lower than that because of the interest rate. 2017, also a beautiful year. I don't mind to compare it to that, but just I doubt it. I doubt it. So August, September, I think we're just gonna consolidate or go up a little bit. I really hope August is the bad month, so September is a good month for us. Just, we have a few days, close below it, give us the red month, and give us 4 beautiful green months. That's what I would like to see, because this month is over anyways. The pain is gone, so just close a little bit under pain. That's why I'm not worried about this little minor correction here, because really the worst is over. I won't see the worst being over. I won't see us up from here. I won't see us battling for new all-time highs. I won't see us breaking levels. I won't see us breaking the wedge. And that's when the real fun starts. I don't want to see us coming down the next few months. That's what would give me red flags, and that would make me reduce my investment. Alright? Again, seriously. If BlackRock is buying, why the hell are you selling? 202 million yesterday alone. 252 million before yesterday. I mean, 23rd of August, right? Last Friday. 64 million. 22. I mean, they're just on a streak of buying. I mean, like, they know something is up. Okay? So, the chart is telling you, the big boys are telling you, I mean, look, BlackRock is almost at all-time highs of the market share of spot Bitcoin ETF volume. Okay? Where else? I saw some interesting one. Yep. Spot Bitcoin ETF AUM, which is assets under management. It's just going up. Alright, we went up, we consolidated a little bit, but we're just breaking the highs again. Alright, we're breaking the highs. Bitcoin it's not breaking the highs, but they are. Okay, so who's selling and who's buying? They're buying. Retail selling. As simple as gets. If you exclude GBTC daily, alright, exclude it. What do you get? We broke all-time highs, god damn it. We broke all-time highs. It's crazy. I mean, they're buying a lot. The on-chain flows, you got expansion, contraction. What comes after contraction? Another expansion. Okay? Usually. Contract, expand, contract, expand, contract, expand. That's how it goes. Also here, if you get the VWAP, that'll be interesting to see. Very interesting to see. I mean, that indicator, I'll probably make a video about it later, but this one usually tells you when big moves are coming. Not session. Give it a monthly. Weekly, I think. Weekly is good. It's not gonna work on here. I made it work on my other chart. VWAP. Auto anchored, okay, whatever. Standard, no. Maybe month. When that contracts, it means big moves are coming, because volume expands and contracts. And when you get a contraction, that tick, usually it looks like that usually. That's when you get a massive move. I wish I could get the VWA other one, not the anchored. Working. I'll show you some of the history, the indicator. Yep. Yep, see here? Contracted, bam. Here, contraction, bam. Contraction, boop, boop. You know? Contracted, dish. I mean, the indicator works so well. The indicator works so well. It's usually false. Some of it is false, but other than that, I was able to catch that. When it contracted, I was buying, and I just flew up. I flew up. Here also did it. Here it did it, and here it did it. Beautiful indicator. A story for another time. So yeah, the asset under management is going up. Another one is the money supply. I mean, the money supply is going up as well. Look, where did we bottom? October. If you go here, October, that's when everything started to skyrocket. That's when the money supply turned and bottomed up to the, that's by the way, American money supply. So money supply going up means money is flowing into crypto soon. See, we just changed to an uptrend. Right, we're consolidating, now we change to an uptrend. It's beautiful. So yeah, a lot of things point towards higher highs for Bitcoin. I do believe we're going higher. I've just showed you many arguments over why this could work to the upside. In another video we're gonna see why it's going to the downside. My probability is that 70% chance that Bitcoin is gonna continue its all-time high run. The bull market did not finish, and it's just boring you out with a bear trap. So retail sells, and again, banks and funds buy. Anyways, I hope you enjoyed this video. I hope to see you again in the next video. Bye bye.